There are some basic principles of capital budgeting. First one is that decisions are based on the cash flows. So in the capital budgeting, we evaluate all the projects and we calculate their cash flows. We do not calculate the accounting income. So decisions should be based on the cash flows, not on accounting income. Not on accounting income. As we know, the difference between cash flows and accounting income, the difference is non-cash charges. The difference is non-cash charges. So here decisions should be based on the purely based upon the cash flows. We do not make any assumptions or estimations. Accounting assumptions or estimations should not be involved in the capital budgeting processes, because here we purely focus on the cash flows. And then as when we talk about the cash flows, these cash flows should be incremental in nature, incremental or marginal in nature. These should be incremental or marginal in nature, because the marginal cash flows or incremental cash flows are those cash flows which are purely related with the launch of the new project, purely related with the new projects. For example, if a new project is launched, let's say we say that in a firm there are cash flows before new project. Let's say these were 100, and cash flows after new project, and total firm's cash flows after new project, these get, let's say, 140. So we can say that the marginal or incremental cash flows are 40. These are the 40 rupees or dollars of cash flows which are purely related to the new project. So here our decisions should be based upon the incremental or marginal cash flow. There, in this case, there is a concept analogy as well. Analogy, we take the analogy of a mini firm. Here we say that a new project should be considered as a mini firm. We should consider its own investing, financing, operating activities. We should not mix it up with the entire firm or with other projects, because we want to focus purely on our project, and so that we can decide either our project is profitable or not, because we need to commit a lot of funds into it. We need to, and we should commit the funds only when we find project is highly profitable. If project is not profitable, we should not commit the funds. So in order to get the project's profitability, we need to see only those cash flows which are related to this project. And then there is another very important principle, which is called sunk costs. As we know that sunk costs, generally you would have discussed in your accounting courses somewhere, that these are the costs which cannot be recovered. These are the costs which cannot be recovered. These have already been incurred regardless of whether a project is taken on or not. So for example, let's say we take an example that, as we discussed earlier, that we want to explore the new market. Let's say if there's a company of foods and beverages, let's say there's a company, food and beverages, and food and beverages company wants to expand its operation to some new region, new market. So when they enter into a new market, a new region, obviously people in different geographic areas, they have different preferences, their tastes, their eating patterns, their preferences regarding taste. These are different. So for that, obviously we'll not go to the new market just abruptly. Before going there, we'll conduct a very thorough market surveys in order to identify that what's the demand of our products in the new markets. So when we conduct the market surveys, let's say you hire a company and your market survey costs, let's say, equal to, let's say, $10,000. So this $10,000 is the amount which you need to pay to the marketing surveyor company. So what they do, so now what do you think, what is the outcome of this market survey? Either they will say that, yes, Either they will say that yes, project is feasible, go to the project, or they'll say no, project is not feasible for you to invest in that market because you won't be able to tap that new market. In both cases, what happens to this cost? In both cases, what happens to this cost? This cost has to incur. Either you accept the project or you reject the project. In both cases, this cost has to incur. So we can classify that this cost is called a sunk cost. Sunk cost for the project, because this is the cost that has to incur if you do the project or we don't reject the project. In both cases, this cost has to incur. So project evaluation principles, what they say about the sunk costs. Project evaluation principle says that ignore sunk costs, because we will not treat the sunk costs in our when later on we'll discuss about the formulation of the cash flows, will not include the sunk costs in the project cash flows. Sunk costs will be treated in the firm's other expenses. It will go to the income statement and expense statements. It will not be included in the project costs, because these costs, either you do the project or you don't go for the project. In both cases, this cost has to incur. So project evaluation principles will not treat it. So this is the basic consideration of sunk costs. Okay, after the sunk costs, there are some external impacts of the project on other firms, other projects, or some firms, other operations can be there. So for example, what's this is called externality. So what we do here, we think that, for example, uh, externalities, first of all, can be positive or negative. Externalities can be positive or externalities can be negative. So positive externalities, for example, when we launch a new project, it may have a positive impact on the previous projects. And after launching the new projects, companies' previous project sales have increased. So this is called positive externality. Negative externality can be that, for example, when a company launches the new project, its sales of the previous project has decreased. For example, we can take a simpler example in that case. For example, there is a company like, let's say, Coke or Pepsi. Let's say uh, Coke and Pepsi, there are regular drinks. Regular drinks. Now, these any of the company, let's say, wants to launch the diet drink, sugar-free drink. So what happens when company launches, let's say, the diet drink? Its sales, obviously, company will record its sales, a certain amount of sales, but something may happen that there are, like, in our social gatherings, for example, there are some instances, cases where people, the when there are some sugar drink, and the people who are diet conscious or let's say having diabetes, they want to ignore the sugar. Let's say in some cases, they had to opt for the regular drinks because of the social environmental pressures or environmental customs. They have to consume the sugar drink. But when company launches the diet drink, then they had clear options that now we don't want to use the regular drink. Now we have to opt the diet one. So in that case, in the diet drink case, there are some new customers of the this diet drink, and there are some old customers which are who are switching their preferences from regular to the diet product, from regular sugar drink to the diet version. So in that, this is called negative externality. The launching of the new project may may have a negative impact on the previous project. If this is so, this is called negative externality. This is also called cannibalization. We also call it as a cannibalization, side effect, or erosion. These are the alternate names of this negative externality. If negative externality happens, we need to adjust it. For example, uh, continuing our example of regular drink and diet drink. For example, we say the sales of Pepsi regular and sales of Pepsi diet. Let's say before diet, or what we call new project, the sales of regular were 100 and diet were obviously no project launched yet. And after diet, after Pepsi diet, the diet sales have gone to, let's say, 50, but regulars sales drops to, let's say, drop to, for example, 80. So in that case, what we need to do, we need to adjust it, because if you remember, we talked about the we have talked about the as previously we discussed about the incremental cash flows. So what incremental cash flows are there right now? Let's say if you see what is the incremental cash flow here, total cash flows before diet were 100, and here total cash flows after diet are 30. So diet sales generally should not be 50. We should not record the sales cash flows of this project to 50. We should not record it to 50. Rather, we should adjust the negative impact, which is 20, actually gets us to 30. So incremental cash flow of this project sales, diet sales, should be 30 rather than 50. Actually, diet is being sold for let's say 50, let's say $1 million, but its sales, because $20 million decline in the regular drink, is because of the diet drink. People have switched, old customers have switched to the new product. So when we adjust it, we'll deduct that reduction, then we'll see that the incremental cash flow is 30. Then we can see that incremental cash flow is 30 rather than 50. And if you see from the principle of incremental cash flows, then incremental cash flows, it is like that: before it is 100, and after that it turns into 130, and in that 130, our incremental cash flow goes to 30 only. Okay, so now we have understood about the negative externalities. So there should be some question in your mind that what should we do with the positive externality? So here capital budgeting principles say that ignore the positive externality. We'll not treat the positive externality, because positive externalities that based upon the principles of prudence and conservatism in accounting, we ignore the unrealized gains or gains which have not been realized yet, or these are expected gains, but we record the losses as expected losses, as we have surety that these losses, their impact has been created. So positive externality is ignored. Negative externality is treated in the while reducing the sales of our new project by the amount the sales which has been reduced or is expected to be reduced in the previous projects. And then there is another very important principle, that is timing of cash flows is critical. We have discussed, you would be much aware about the time value of money. We know that their cash flows, obviously when these are the long-term projects are the cash flows over multiple years, cash flows over multiple years. So let's say it's a 5 years project, so cash flows will be spread out in the multiple years. So obviously we know that we cannot simply add or subtract the cash flows like this. In order to evaluate, we need to either discount or compound. Discounting means calculating present values. Compounding means calculating future values. So we need to discount all the cash flows. And then based upon that, if we are making decisions here, then we need to discount all the cash flows and then decide either it is profitable or not. So obviously this discounting it has to be done. We cannot simply add and subtract all the cash flows over timeline like this. Okay, ji. So then we have another important principle that cash flows are based on the opportunity costs. This is a case, for example, just if you take a very simple example that a company wants to do a new project, and then in that new project, company requires, let's say, heavy heavy duty printer, heavy duty printer. And a company just found that they have some time ago, 1 or 2 years ago, the company bought that heavy duty printer for some purpose, but they are not using it. That in very good condition is already available in the company's store. So company decides obviously to use that printer which company already owns. So company is the owner of that printer, so company should use it. So in that case, what project evaluation principles say that we'll not use the printer as it is. Rather, we will consider its cost in our cash flows. We should consider its cost. Now, the cost, how much that cost can be, let's say, if replacement cost can be there. One of the common example that, for example, if we right now in that case we take it to the that printer to the market to sell it out, then what cash flow we could generate after selling that printer, and that cash flow which we will miss if we use that printer for our new project. So that cash flow is called the opportunity cost. That what is the highest available opportunity for that printer that could be sold into the market, and we can get some cash flows out of it. And if we do not sell it in the market, do not get the cash flows from it, then that cash flow is called opportunity cost, and we will consider that these cash flow as a cost in our project's cash flows. So this cost will be considered in the project cost. And then there is another important principle, that's cash flows are based on after-tax basis. Obviously, we want to calculate the profitability or liquidity or any other evaluation criteria want to see. We want to see the project's profitability, that profitability which is going to be retained by the firm rather to be distributed to the governmental agencies. So we want net profitability. So we will deduct all the taxes and will calculate the cash flows which are purely after tax. And then after that, there is finally there is another very important principle, which is financing costs are considered in discount rates. So there should be an important question in your mind that where financing costs will be treated in the financing cost, let's say, which can also be called as cost of debt, cost of equity, or mixture of both. We can say cost of capital. So this is the capital. The important thing is that in order to do this project requires, let's say, $1 million of investment. So from where you'll generate $1 million? Either you'll borrow from the banks or from any other source, either private or public source of debt, or you'll generate some equity. You may issue some shares, or you may use your internal equity, what scenario it is. In all cases, there is a cost. So cost of debt, cost of equity, or if we may use the combination of both sources. So then we can say that cost of capital. So this cost of capital should be reflected in the discount rates. This is a principle that financing costs, or we can call it as cost of capital, should be reflected in the discount rate. Discount rates will be used, like, for example, we will later on will identify project cash flows. Cash flows are at different time periods. And then what we'll do, as we discussed about recently, that about the timings of the cash flows. We discussed about the timings of the cash flows, time value of money. We cannot simply add and subtract. We discussed about it. So here we need to discount it. We need to calculate these cash flows, present values. While calculating present values, the discount rate should be this cost of capital. So cost of capital should be reflected in the discount rate. Discount rate might be even higher than cost of capital, depending upon the company's preferences, company's board of directors preferences, depending upon their preferences, discount rate can be higher than cost of capital. But at least what we say that whatever cost of capital is there, it has to be reflected in the discount rate in order to calculate present values.